Bear markets happen. They're a natural part of a market cycle. We know that on average, they come every 5 years, but obviously it's not clockwork. And so we're 3.5 years into this, and we've had a bear market and a bull market. So 20% growth is a bull market, and 20% downcline is a bear market. And so whether it's bull or bear, they all happen. The problem is when you get in a bear market, your mind starts to play games with you. It starts to say that this thing is different this time. The 4 most dangerous words in investing from Sir John Templeton is it's different this time. It's really not. Even with the bear market that we had in bonds this year, we had it in 1976 too. So how do you handle it? What do you do? First of all, you buy whenever you can. And so if you're in a 401k or you're dollar cost averaging, which means putting money in systematically every month or pay period or whatever, keep doing it. Yeah. In fact, you should want this to happen periodically so you can buy more shares when things go down. So anyway, just keep buying. If you're in retirement and you're spending, don't be selling shares that have gone down in value. You know, if you were taking $1,000 a month out, and your investment was at $100 a month, you'd sell 10 shares. If all of a sudden your investment now is at $50 a month, you're selling 20 shares. The market has told us, history has told us, we're always going to get back to $100 a share. The market does hit all-time highs. The question is we don't know when. And so when you sell those shares at 50 versus 100, it's hurting you. And so you need to have a strategy set up that's different when you're in retirement taking income, dollar cost averaging out, versus dollar cost averaging in. And so in a bear market, a lot of times you got to look the other way, and you've got to like put the statement away and just say, I'm buying on sale and things will get better. And then if you're in retirement, you just need to make sure you got the right strategy set up that you're not selling shares on sale. Very cool. But it's not easy.
It is
sure.
Not easy.
No.
Well, this is what guys like you are for.
Well, and I always tell my team, Matt, I always like, listen, this is when we make our money. The fact that we're there to answer the phone and communicate and be a voice of reason to our clients and ask them what's changed in their life. And all those conversations is behavioral finance. It's not necessarily price to earnings ratio and alpha and beta and these fancy terms that try to sound like I'm more smart than somebody else. It's really behaving correctly when the market is like this. You just can't get out. The average investor does not beat the market. And the reason is because they don't behave correctly. When the market's going down, they're getting out, and the market's going up, they're buying. They should be doing the opposite, but it's hard. So having a voice of reason makes sense.
That's where you guys can be helpful. I love that.
You bet.
All right. Well, we will see you back here next time on the iWealth podcast.
Thanks, Matt.